What's up, everyone? This is Marcus again with your not so weekly tax tip. So let's talk about selling property to family members. When you sell property to a family member or a loved one, it is deemed a related party transaction by the IRS. Now, if you're contemplating a transaction like this, you need to review the tax consequences of your decision before you do anything. So, a related party transaction covers relatives like your children, grandchildren, but it also applies to business entities that you own. So here are 4 common situations that you might encounter and tips to help you avoid some of that tax trouble. Number 1, installment sales. So when selling your property over 2 or more years, your transaction is deemed an installment sale. Now, with an installment sale, you can defer tax on your gain until the tax years in which your payments are actually received. However, if you sell the property to a related party who disposes of it within 2 years, the remaining tax is immediately due. So, how can you solve this problem? Well, what you need to do is you need to insert language in the legal agreement with your related party that does not allow the selling or the disposition of the property within that 2-year time frame. All right, number 2, if you sell at a discount. So if you're selling your house to a related party, you may want to give that person a sweetheart or a family deal, right? Unfortunately, the IRS may reclassify the transaction as a gift if the property is sold at a considerably less than its fair market value, right? So fortunately, you have some wiggle room. If you discount the sale by less than 25%, then you should be okay. Quick tip. You need to err on the side of safety by having an appraisal of the property before the transfer date or build documentation that justifies the fair market value. And then you have transferring remaining interest. So in some cases, a homeowner may transfer an interest in a home to his or her estate while continuing to live there. Now, although this might meet certain objectives, the estate won't be able to take advantage of the $250,000 home sale exclusion. It's $500,000 if you're married. However, if it meets subsequent to 5-year ownership rule, the exclusion may become available. Now, quick tip again. Prior to transferring interest in a home to anyone, including a trust or an estate, you need to understand the impact of this action on the tax-free home gain exclusion. And then last, I want to talk about like-kind exchanges. So often, instead of selling business or investment property, an owner may trade for another similar property, hoping to either defer or to avoid taxable gains. Now, under recent legislation, tax-free exchanges or like-kind properties are eliminated, except for qualified real estate transactions. The tax is generally deferred until the replacement property is sold, but the tax law imposes a 2-year holding requirement on the parties to the deal. Now, you may qualify under a special exemption, such as proving tax avoidance wasn't the purpose of the sale. A lot of stuff, but quick tip, related property transactions of this type, it can get really complicated. You should ask for a review of your situation before trading any property, all right? Because transferring assets, including property to the family, gets the attention of the IRS. So should you be contemplating one of these things that I've outlined, please reach out for assistance before you make any move. Until next time.